11 things to do prior to pre-approval. Ever been confused about mortgage pre-approval? You're not alone. Many clients wonder what a mortgage pre-approval process entails. Not to be confused with a pre-qualification that just relies on stated income, stated assets, and credit. A mortgage pre-approval verifies that information and covers the most recent 2 years of your employment history, residency, household details, a credit check, as well as confirming the total amount of assets intended to be used for closing. Often, this involves proof of income with recent pay stubs, W-2s from the previous couple of years, and 2 months bank statements, or investment account statements proving available assets to close. This all helps determine which loan programs are applicable so that you know which property types are eligible as well. Since many realtors or sellers require a pre-approval to schedule showings, the pre-approval letter that would accompany your potential written offer sends the message to sellers and listing agents that you are a serious contender and ready to go. But clients often go into a pre-approval not knowing what to do prior to the pre-approval. Here are some things that we have seen that could help ahead of time before completing the pre-approval process. Number 1, consider your cash. There are very strict rules for anti-money laundering reasons regarding bank statements and cash deposits. Cash on hand cannot be used for the home purchase in most cases because it cannot be sourced to prove the origin. We've seen a variety of legitimate reasons that people have a lot of cash they want to use, such as selling vehicles or personal property weeks, months, or sometimes years before, just preferring to save it at home or earning a lot of cash over time from a side job. As a general guideline, underwriting will require 2 months worth of bank statements, and if there are any non-payroll deposits, including cash deposits, those need to be sourced to be used. If you have some cash at home you plan to use for the home purchase, make sure you get that money deposited long before getting serious about your home search. Number 2, check your credit report. A good place to start before getting pre-approved is to check your credit report for accuracy at annualcreditreport.com. You can get a free credit report every 12 months from all 3 bureaus there. This report does not contain your credit score. It does, however, have a history of every creditor you've ever had. Each itemized item on the report is called a trade line. It's especially helpful to review and make sure there are no accounts that are currently in dispute. Use it to address any open collections, and check it for accuracy to make sure that there are no fraudulent accounts that you did not open. Derogatory trade lines stay on your credit report for 7 years, so hoping they will go away is not a strategy likely to help. Number 3, confirm your credit score. The credit history on your report determines your current credit score. The 3 bureaus, Equifax, Experian, and TransUnion, calculate scores differently, which is why the scores vary. One free website to check your credit score is Credit Karma, but feel free to find one you like. Keep in mind that a mortgage credit report is different from what Credit Karma and similar companies display, but it's a good starting point. Most credit card companies provide access to at least one credit score when you're a customer, so that could also be a helpful place to check as well. Credit scores range from 300 to 850, 300 being the lowest score and 850 being the highest. In general, most traditional home loan financing options are going to require a minimum credit score of at least 580. Then each 20-point improvement above 580 is a cutoff for better rates, loan programs, and pricing. As an example, if you can raise your score from 580 to 680, the rate you all have access to will improve because your credit score now implies you are less of a risk than you were at 580. Anything over a 760 is considered excellent credit, and you do not really get any bonus points over 760. Rates are the same at most lenders for a score of 760 and above. Don't have a credit score? Consider applying for a secured credit card to start building your credit. You can also request to have your monthly utility payments reported to help give you a good credit history. Fear not, reporting your utilities will not count against your debt-to-income ratio, even though they're added to the credit report. Number 4, follow a written budget. If you don't follow one yet, it's a great time to start. Sign up for an app that does the work for you. There are many ways to develop your budget. Some like physically cash stuffing envelopes. Some use Excel, and still others use an app or program, something like mint.com, pictured here. Keep in mind that as discussed earlier, cash is nearly impossible to source. There are many programs that do tracking for you. If you have a budget, you'll have a much better idea of what you can realistically afford. Sometimes the mortgage guidelines of what clients qualify for are much higher than what they actually want to spend. Other times it's the reverse. Clients have a bigger budget in mind than they can afford. Don't forget to account for additional costs for maintenance, upkeep, heating, and cooling, especially if moving from a smaller home to a larger one. Number 5. Pay late bills. Pay any bills that are past due. The longer it is past due, the more it hurts your credit score. If you are a chronic late payer, that will definitely hurt your score over time. Many times, lenders will require explanations about why payments were late. The longer the payment is late, the more it hurts, and they are usually gauged in billing cycles such as 30 days late, 60 days late, 90 days late, etc. And as mentioned, the longer it is late, the worse it impacts your score, so target the longest overdue first. Number 6. Set up auto pay for the minimum payment on the due date for all accounts. A missed payment can lower your credit score up to 100 points. It can be simple to forget or miss a payment. Even a $10 bill that you miss for a couple of months or forget about can really bring your score down. By setting all bills to auto pay at least the minimum payment on the due date to avoid missed payment risk in the future, this protects your hard-earned credit score. Number 7. Pay off low balance debts. If you can pay off any low balance debts, especially if they have high interest rates, prioritize these to lower your debt to income ratio. The low balance due will be different to each person, but if they are easy for you to pay off in full, especially if you are paying interest on them, this might be a good use of excess funds in your checking or savings account. The lower debt to income ratio may help you qualify for more or at least feel better about your monthly cash flow. Number 8. No new credit. Applying for new credit can hurt your credit score, and new debts can impact your qualifying. We have seen clients apply for credit for furniture for their new home prior to closing that prevented the closing from occurring. Another common issue we see is new vehicles. Those can also derail the purchase. Many times the reason for not being able to qualify for the house you like is sitting parked outside. Make sure any potential added debt will not cause you to no longer qualify for the mortgage. Always check with your loan originator or officer before applying for credit, after a pre-approval, or once you are under contract. Lenders usually monitor your credit prior to closing and will receive a notification if you inquire about new credit, so they'll be watching. Number 9. Learn hidden costs. Many first-time buyers express they wish they knew more about the hidden costs of homeownership. The costs are not hidden per se, but sometimes we just don't think about them. Moving can be pretty expensive. Activating utilities and services at the new property can come with fees. Heating, cooling, water, and sewer can be more expensive, especially if the property is bigger. And renovations or required repairs can really add up quickly. It's a good idea to try to anticipate any of these costs if possible. Number 10. Please subscribe to our channel. Instead of researching things on your own, learn from us over time. We will continue to share content about housing to help you make informed decisions. And number 11, get an official loan estimate. Loan estimates are no cost and no obligation. Make sure that all the costs are close to what you think they are in the price range you are considering. Many clients have sticker shock when they receive their first loan estimate. This is because the down payment amount and cash to close are very different in mortgage terms than they are for other types of loans. Also, since most payments include principal, interest, taxes, and insurance, and any homeowners or condo association dues, sometimes those costs are overlooked unintentionally. A loan estimate is a good place to start to make sure the price range you are looking in is one that is good for your budget. We think that list is a pretty good prior to pre-approval starting place. What might you add?